Hello world, my name is Ara. I am a full-stack web developer and a passionate investor. Today I would like to talk about the difference between index funds, mutual funds, and hedge funds. So there are two main differences between these three different types of funds. One thing that they all have in common is that a fund is a group of stocks that me, you, and everyone else can invest in. So let's say I take $1,000 and I buy shares of this fund. Someone else takes $1,000, they buy shares of the fund. Someone else takes $20,000, they buy shares of the fund. Someone else takes $500, they buy shares of the fund. They pool our money together and they use our money to buy groups of stocks. Now, some index funds and mutual funds and hedge funds, they are very significant in value, meaning tens of billions of dollars, maybe even hundreds of billions of dollars. So these funds can get very, very big, and when you buy shares of the fund, you get a proportionate amount. So the first main difference between the three of these funds, which is a significant difference, is are they actively managed or are they passively managed? So index funds are passively managed, meaning the managers are not doing daily trades. They're not buying shares today, selling shares tomorrow. They're not doing any of that. The shares that they own in the companies are going to be held for the long term, however long that is. Once in a while, trades are made, but that is very infrequent and happens only once in a blue moon. So, stepping up from an index fund would be a mutual fund. Now, these would be called actively managed, and there might even be teams of managers managing these funds. And they are buying shares sometimes and selling shares sometimes, getting into the sectors of the economy that they think are probably going to grow a little quicker sometimes. It really depends on what kind of mutual fund you have. You can have a mutual fund that invests in oil companies. You can have a mutual fund that invests in technology companies. And sometimes they're trading in and out of these stocks. And they are typically not as diversified as index funds. A lot of times index funds will be groups of companies that represent the whole market in general. And mutual funds are typically not as diversified, although they can be. Either one of them can be diversified or not diversified. But a mutual fund, the basic point is actively managed. So the third on the list is a hedge fund. And a hedge fund would probably be considered very actively managed. They might go into trickier trading strategies, such as shorting stocks that they think are too expensive, meaning they'll profit as the stocks fall in price. They might invest in call options and put options, and some stuff that everyday investors are not familiar with. So that is the difference in the way that they are managed. To recap, index funds are passively managed, mutual funds are actively managed, and hedge funds are very actively managed, to put it simply. So the other big difference is how much fees are you paying for these funds. So the index fund that I bought for my daughter was symbol VOO, and the fees that they charge were 0.05% per year. So if you invest $10,000 in this fund, then you are only going to be spending $5 in fees per year. So $5 is a very, very small amount of money. So I just think of $5 as nothing, so I think it is very worth it. All the dividends that these companies make in the index fund do get paid to the fund, which eventually get paid to my daughter. So 0.05%, 1/20th of 1%, to put it another way, is a very, very small fee to pay, and it's close enough to zero that you can think of it as insignificant. The reason these funds can charge very small fees are because they are passively managed, and there are no managers and advertising costs that the fund needs to spend money on. Next on the list would be mutual funds. Mutual funds, as we know, are actively managed, and a typical fee for a mutual fund might be 1%. So if you have $10,000 invested, they might take $100 a year. Now, this fee can range, and there are mutual funds that probably charge a little over 2%. I have never personally seen a mutual fund that charges 3%, but there might be some out there. I think a ballpark average for a mutual fund fee would be about 1%. And they do go less than that too. It all depends on the mutual fund. There are thousands of mutual funds and thousands of index funds that you can invest in. But as a general rule, index funds are passively managed and can charge very, very low fees. That might be 1/4%. The big reason why I invested in my daughter's index fund was because it's 0.05%, which is extremely low. And fees can eat away at your return. So mutual funds charge a little more, basically, to summarize. 1% might be a good ballpark or a starting point of what to expect when you see fees for a mutual fund. Now on to hedge funds. Typically hedge funds are reserved for very high net worth investors. I've never came across a hedge fund that I was allowed to invest in. They usually have minimums that you can invest, like $250,000 for example, might be a minimum for a certain hedge fund. So hedge funds, because they're very, very actively managed, charge very, very high fees. A typical fee for a hedge fund might be 1 or 2% of the amount you have invested, plus the hedge fund manager might ask for 20% of the total amount you make. So if you were to make a 20% return on your money, so if you were to invest $250,000, on top of the normal annual fee, if you were to make 20%, now your account would be worth $300,000, and they would take 20% of that profit. You profited $50,000, and they would take $10,000 of that profit. So hedge funds are very, very high fees, and typically reserved for very high net worth individuals. So I probably would not recommend investing into a hedge fund if you have that much money, and I would probably not recommend investing into a mutual fund. I would probably recommend, in most circumstances, investing in an index fund, because there is no reason to pay higher fees than you need to. There's no reason to pay more than 0.05%, because studies have shown that most mutual funds underperform the market, and hedge funds have trouble outperforming the general stock market too. Therefore, if you're just going to invest in the general stock market, typically you do just as well as if you're paying higher fees for a mutual fund or higher fees for a hedge fund. So to summarize, in my opinion, I think index funds are the best because you can invest in a diversified group of companies, typically representing the whole stock market, and you only have to pay very, very small amounts in fees. So thanks for watching. To all my new subscribers, thank you for subscribing. I see a lot of people are learning from this channel because everyone's messaging me on Messenger and Facebook, and I have a whole bunch of new friends on Facebook, and they're also texting me if you have my number. Feel free to ask me any questions. I love to talk, so I will see you next time.